Welcome to Acquire, Optimize, Realize, a video series for the private equity industry. Today's topic is focused on technology, software, and other investments where due diligence is based on annual recurring revenue, or ARR. I'm Cameron Smith with Cherry Bekaert's Private Equity Services, and I'm joined by Sean Geoghan, who leads our tech M&A team. Sean, it's good to have you.
Hey, Cameron, glad to be here.
It's been an interesting start to 25 in so many ways. Sean, how is the state of the tech M&A market?
We've seen the tech M&A market being very resilient and only showing signs of growth for 2025. Areas like AI, blockchain, health tech, fintech, education tech, we've seen continued expansion. We think it's a very attractive market for capital deployment, both from a sponsor and lender base. We've seen SaaS businesses with recurring revenue models often enjoy higher customer retention rates. Subscriptions, memberships, service contracts create continuous relationship between the company and its customers. Businesses with higher customer retention rates through their recurring revenue models are often seen as more valuable businesses. So if companies can scale their businesses quickly and the cost to serve each customer goes down as the company's revenues grow. Finally, I'd say that revenue then becomes a very predictable stream, which makes forecasting profitability much easier.
Sean, how is the due diligence process for tech deals different?
Knowing sponsors seek to leverage these transactions, traditional cash flow or EBITDA analysis may or may not be a consideration. Sponsors and lenders would then use a variety of ARR tools to diligence these deals. Cherry Bekaert refers to this type of analysis as a recurring revenue valuation, or an RRV. And the process has become far more common than ever before to keep efforts deploying capital into solid companies, predominantly tech and SaaS businesses with high annual recurring revenue, or ARR, as you mentioned. Investors and lenders in this space often use multiples of ARR to determine a fair market value, as well as use valuation tools and methods like discounted cash flow, or DCF, where higher interest rates translate to higher discount rate and a lower present value of cash flows, meaning a lower loan, lower valuation. But despite that, we've seen recurring revenue businesses are generally considered a positive factor in valuation, mostly because it provides predictability and stability of their cash flows, which can partially offset any negative effects of a higher discount rate. In diligence, the difference between diligence on a traditional business and a business space with recurring revenue means the lender just has to do its underwriting and diligence in a little bit different way. Specific KPIs and ARR will be the focus, and will tell the lender the strength of the loan and the underlying risk of that loan.
Would you share some of those KPIs?
Sure. Lenders are looking at a number of different KPIs for predictable income stream, which allows them to forecast their future earnings and lower the risk associated with that loan. So one of the big KPIs they look at is the Rule of 40. This is also used to evaluate a company's balance between the growth rate and the profitability, where a company with a higher growth rate can offset lower profitability. In our due diligence process, or again, as Cherry Bekaert refers to as a recurring revenue valuation, or RRV, we consider key metrics like customer acquisition costs, LTV to CAC ratio, gross churn rate, and net revenue retention to assess revenue stream and future growth potential.
Sean, is there anything else you'd like to add?
Just that it's been interesting to see how these trends in tech and SaaS investing and lending may be evolving into other industries. For example, professional services, consumer, residential businesses, which are adding or expanding recurring revenue models to power their growth and stability. Cherry Bekaert is closely following how our more traditional lending clients can embrace our recurring revenue valuation just beyond tech and SaaS to support the evolving landscape.
Thank you, Sean, for your insights into lending and investing into annual recurring revenue and Cherry Bekaert's approach to recurring revenue valuations. To our viewers, this series is designed to briefly highlight challenges and opportunities faced by the private equity industry. If you have any questions or need any additional information, please don't hesitate to contact us. Thank you.